All right, now, here's a thing I wanted to talk about for a long time because I see people posting up comments here, and it makes me realize that a lot of you, unfortunately, still think we're living back in the 16th century, but we're not, okay? We live in a world where double entry accounting is the norm. And what do I mean by that? Well, let me give you an example. When I've been talking recently about the rise in interest rates and how that is a fiscal expansion, how that is price setting higher, how that's inflationary, some of you are saying, well, yeah, really inflationary. What about the business owner who goes out of business because rates have gone up too much? Or what about the homeowner who can't pay the mortgage, assuming he or she has an adjustable rate, who can't make the payments, or they can't make the payments on the car? Really inflationary, huh, Norman? So, that exposes a, quite a bit of ignorance on the part of the person who makes a statement like that. I mean, you really don't understand the system, okay? Because if you are so concerned about that homeowner or that person making those car payments or that business owner who is affected by the higher interest rates, then let me ask you, were you as concerned when rates went down to zero for the well-being or the income lost by the saver or the creditor? So this is the point. For every debtor, there is a creditor. For every borrower, there is a saver. And for every liability, there is an asset. And the way you got to think about interest rate adjustments is just a redistribution of income. When rates are going up, it is detrimental to borrowers and debtors, right? Their income, they have to pay more. So in effect, they are experiencing a removal of income. However, for savers or creditors who earn that income, they are experiencing an increase in income, and vice versa. When the interest rates went down to zero, right? When the Fed took the interest rates down to zero, that equated to a net loss in income on the part of savers and creditors, and it equated to an increase in income on the part of borrowers and debtors. Okay, and you could see it very clearly. Like I've posted these charts on my blog, and I send them out from time to time, that you see interest income, which is a component of personal income, in the period from 2008 till about, 2010, 2011, when the Fed dropped interest rates down to zero and was really buying assets with quantitative easing, interest income collapsed. I mean, it was down something like over 200 billion. That's net reduction from national income, all else equal. That was a reduction. It has since recovered as the interest rates have climbed back. Okay? Nobody talks about that, except for myself, and that was one of the reasons why we never saw the inflation or even the hyperinflation that all the crazy people and the quacks were predicting, and even some of the most well-known economists. They were all, not me, I was saying, and I was still on TV at that time, I was saying you're not going to have inflation because it is a net removal of income. You're not going to get inflation when they're sucking out income. All right, when they lowered the rates to zero. Now, when the rates are going up, yes, some people and some entities, firms, people, they're going to get affected. It's going to be a net removal of income for them. They're going to have to pay more, which equates to a removal of income. But at the same time, creditors and savers, they're going to be earning that money. So all that is happening is a redistribution of income. So, and again, that's the way I explain it, and it is the easiest way to understand it. I mean, it is the easiest and most correct way to understand it. Rate adjustments, 2 things you have to understand, or 3 things. Rate adjustments are price adjustments. They are fiscal operations, and they are redistributions of income. Okay? The money doesn't fly out into outer space. It gets shuffled around a little bit differently in the economy. All right? So, when the central bank raises rates or when the government raises rates, they are increasing prices because that is increasing the cost of credit, and the cost of credit is reflected in the price of all goods and services. At the same time, since the government is a net payer of interest, that is a fiscal expansion, money printing. All right? That's the money printing that all these kooks and idiots were screaming about during when they were lowering the rates to 0 and doing quantitative easing, which was not money printing, that was actually money unprinting. They should all be out there right now screaming, they're printing money, they're printing money. They print the money, but they're not. They don't understand it. They're stupid, and they don't want to understand it. So, that's all it is. That's all it is. So when you say things like, what happens to the business guy, Mike? He goes out of business. That's not. What about the savers and the creditors? They earn. And by the way, to make a final point, which is a very, very important point, the non-government, that is everybody else besides the government of the United States, in the case we're talking about the U.S. here, the non-government is a net creditor. That's right. They're a net creditor to the tune of whatever our so-called debt is, 20 trillion. So actually, when rates go up, it has a powerful effect because it benefits the creditor class, which is the entire non-government of the United States of the world, to the tune of 20 trillion, whatever the so-called debt. It's not really debt, but it benefits in the aggregate. It may not benefit each of us individually, but in the aggregate, it benefits. So there you have it. Very easy to understand. You got to boil these concepts down into easily understandable little snippets of information, little, bullet points of information. Clear up your head about all this. Understand the monetary system. Understand how it works. And it's not all these idiots on TV claiming we're going to have hyperinflation. They're printing money, biggest crash we're ever going to see in our lifetime. Whatever happened to that? Jim Rogers, remember after Brexit? We're going to have the biggest crash we ever seen in our lifetime. What happened to that? We had the biggest rally you ever seen in your lifetime. All right? So, everybody, come on, just chill.